Gold, a lot of reasons to be going up. It doesn't mean in a straight line. When the world understands gold, it's usually when there's quote unquote blood in the streets and chaos, sadly. And that doesn't mean I'm looking for chaos. I see signs of chaos everywhere right now. I think we all do. It's very subtle, but very real. Gold steps in, but it still preserves its purchasing power. I don't know. We're not going to see a gold backed dollar. We'll see gold having a higher role in its percentages and coverages. Gold is going to go to double digits in very much in my lifetime because currencies are going to get continually weaker. They've gone weaker ever since I was born and before then.
Sorry, when
But
you said double digits, you mean 5 digits, right? 5 digit goal.
oh yeah, but I mean, double. Yeah, I'm sorry, 5 digits, at least 10,000. I do believe that. I think that's minimal.
MatthewPiepenburg, the co-author of Gold Matters, highlights that the global gold allocation is around 0.5%. If allocations were to revert to the historical mean of 4%, the value of gold could increase eightfold. Even a return to a 2% allocation could quadruple its value. The broader view on gold suggests its price is in a wait-and-see mode, closely tied to upcoming U.S. economic trends, Federal Reserve policy, and emerging market central bank gold purchases. The clearly defined range of $2,430 to $2,285 reflects this cautious stance, though traders are finding opportunities within this $145 range. Piepenburg emphasizes that while experts have a broad consensus that gold will hold or increase its value in the long term, it's not a cure-all investment. Significant market downturns can impact gold prices, but the general expectation is that gold will ultimately rise due to ongoing currency devaluation and economic instability. According to a report by FX Empire, metals and miners are nearing cycle lows. From this point, an aggressive rally is anticipated into August, with the potential for gold to reach $2,800. Gold is close to confirming a June cycle low, with expectations of new all-time highs in July and a possible price spike towards $2,800 in August. Piepenburg also discusses extreme economic measures such as defaulting on U.S. treasuries, drastically cutting defense spending, or restructuring the economy. These actions would lead to severe economic consequences, including soaring inflation and significant losses for bondholders and pension funds. Still, he predicts that gold would rise in value under these conditions. In related economic news, U.S. inflation fell to 3.3% in May, raising expectations of early interest rate cuts and boosting the stock market and President Joe Biden's standing. The data, released just hours before Federal Reserve officials outlined their plans for rate cuts this year, was slightly below economists' expectations. This shift in inflation and potential rate cuts could further influence gold's trajectory, aligning with the broader anticipation of its value increasing amidst economic fluctuations. Join us as we delve into Matthew Piepenburg's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
The 40-year mean for physical gold allocations is actually 2% or 4%. Actually, it's 4%, and it's gone as high as 6%. But if you take the 40-year mean of 4% and your current allocation of 0.5, if we just revert back to the mean of a 4% global allocation to physical gold, that's a
That's 8 times.
0.5. Yeah, it's 8 times. If we go to 2%, that's 4 times. Gold has a lot of reasons to be going up. It doesn't mean in a straight line. But when the world understands gold, it's usually when there's quote unquote blood in the streets and chaos, sadly. And that doesn't mean I'm looking for chaos. I see signs of chaos everywhere right now. I think we all do. It's very subtle, but very real. Gold steps in, but it still preserves its purchasing power. Now, I think we're going to see, I don't know, we're not going to see a gold backed dollar. We'll see gold having a higher role in its percentages and coverages if we lose faith in gold. But if even we have a 20 or 40% official or unofficial gold coverage in our World Gold Council reports, I think gold has a 6x, 7x return just on that metric. But that's wonky too. I also want to say, so people don't think I'm just selling my book and that all you need to do is buy gold. It doesn't solve all the problems. I think gold is going to go to double digits in very much in my lifetime because currencies are going to get continually weaker. They've gone weaker ever since I was born and before then.
Sorry, when
But
you said double digits, you mean 5 digits, right? 5 digit goal.
oh yeah, but double. Yeah, I'm sorry, 5 digits, at least 10,000. I do believe that. I think that's minimal. That doesn't mean gold can't go down, even significantly. There's a guy from Denmark, I think Henrik Zaberg, who thinks gold could actually go down to 1250 if we have a market crash, because like 2008, everyone needs liquidity. They sell their gold.
Yep.
They need dollars. Silver ETFs are going 800 or 400 billion in outflows. That's just because there's more physical delivery. But I'm saying there is a case to be made that even gold can see a major price swing down, especially in a major market implosion. I'm not saying gold is going to solve every problem. You should be 100% in gold, and you shouldn't speculate, and you shouldn't look at other assets, and you shouldn't, go for it like you and I did in the 90s during the dot-com bubble. Be very, very careful, because not every ending is happy in those stories. You can be lucky more so than you can be intelligent. You confuse that luck. But if you have wealth or you have enough to try to preserve, you can't ignore gold. But I don't want to say that gold goes up, but I don't see right now a scenario, even if we had a market or a deflationary event, a dramatic deflationary event, where gold doesn't get the last laugh. Because even if we had a market implosion, a Great Depression, like Zebrick says, and gold sells off, it won't last more than 20 seconds, because the governments, to stay in power, will have to go into deficit spending and stimulus to stay in power. And that you can count on. You can count on them doing whatever it takes to not default on their treasuries, to stay in power, to fiscal and deficit spend. And then that will be inherently inflationary, and gold will again rise. And everyone, whether you're a Bitcoin debate about gold, or whether you're strong dollar, weak dollar about gold, like Brent Johnson and I discussed the dollar, whether you're Ronnie Sturfula or Larry Lepard talking to Peter Schiff about Bitcoin versus gold, or you're talking deflation, inflation, we all agree that at some point gold gets the last laugh. That's not me being a gold bug. That's not Egon or Ronnie Sturfula or any buts, or even Larry Lepard or any of these Bitcoin guys. We're not gold bugs. We just see the writing on the wall about fiat money getting weaker, and there is no productivity miracle. I suppose the only other solution you could have is you let U.S. Treasuries default. You let and therefore the big banks that own them fail, and you go into a true deflationary restructuring. You cut entitlement defense by 50%. You could reshore production, and that would probably put the Fed balance sheet at 25 to 30 trillion, deficits at 5 to 6 trillion. Inflation would skyrocket, bondholders and pension funds would get killed, but gold would still go up.
The Reserve Bank of India has increased its gold reserves by around 1% in 2024, reflecting a response to the current global geopolitical uncertainty, including trade tensions, political instability, and conflicts like the Russia-Ukraine war. This diversification away from foreign currency assets is seen as a strategic move to strengthen the resilience of its forex reserves. According to RBI data, gold reserves stood at $56.982 billion as of June 7th, making up 8.69% of the total reserves, compared to $48.328 billion on December 29, 2023, when they accounted for 7.76% of the total reserves. MatthewPiepenburg notes that when central banks accumulate gold, they anticipate potential economic upheavals. They perceive economic instability on the horizon and seek to fortify their reserves with a reliable asset. Historically, gold has often served as a reserve asset during economic transitions or crises, providing stability and security amidst financial uncertainty. Let's get back to the interview.
When you see central banks stacking gold, it's because it's like an army preparing for the other army coming near the border. They see the pickets and the soldiers and the cavalry and the tents and the cannons, and they're like, okay, it's not going to be a hot war. It's going to be a currency issue. It's going to be an economic issue. We need to get ready for a new reserve asset. Gold has been a reserve asset many times throughout history when economies break and there's a new system. I don't think the ruble is going to replace the dollar or the yuan is going to replace the dollar, but gold is going to net settle. It's going to be a net settling trading currency, and it's going to be a reserve asset. It already gets a better return than U.S. Treasuries. So nations are trading gold the same way our clients do, as a reserve asset, not as the only asset they own, but as the way that they save their money. When they need liquidity, they'll call our broker desk and convert it to euros or Canadian or US dollars when they need to buy something. But they're going to save in something they trust, something with a finite supply and an infinite duration. A US Treasury has infinite supply and a finite duration, but it is no longer trusted, not only because we weaponized it, but because we debt soaked it. And we're going to create more of those IOUs, and we're going to effectively buy our own debt through a number of mechanizations, not just direct QE, but all the things I mentioned earlier, all those tricks from the TGA and the reverse repo to the SLRs. We'll be buying our own debt. We'll be debasing our currency. Why would you want to own, as a safe haven asset, an IOU from a country that's that in debt with a currency that's that debasable, even if it is the world reserve currency? It's simply going to lose more and more of its purchasing power. And again, since 1971, like all fiat money, since we've got off the gold standard, even the US dollar, when measured against gold, has lost over 98% of its purchasing power. That is a hard fact. That doesn't mean gold always outperforms the S&P or that gold always outperforms the US or the DXY. It just means, and I'll use that other graph I sent you. If you bought a house in 1920 with 250 gold coins, 250 ounces at $20 an ounce in 1920, it would cost you $5,000 to buy the average U.S. house. So that would take 250 coins. Well, if you fast forward to 2024 and you had that same shoebox of 250 coins, you could buy a $500,000 house, which is the average median price of a house in America. But if your grandmother gave you $5,000 in a shoebox from 1920 and you use that today, it wouldn't buy you the landscaping in that house. But if she gave you that shoebox of gold coins, you could still buy the average U.S. house. That's what is important about gold to understand. It doesn't make you rich. It preserves the purchasing power. It buys things for you that dollars can't over the long run. And if you're a legacy investor, not a speculator, if you're a family office or you're a sophisticated investor who has enough wealth, you're thinking not just 10 minutes ahead. Ronnie Sturfler gave a great lecture about this. You have to be thinking generations ahead. Americans think about the next sweet car if they have money. And if they don't have money, sadly, they're thinking about just how to get to rent. And I respect that. But I think this mindset of understanding the purchasing power, not the sexy SPAC-like returns or the NVIDIA-like returns, the opportunity costs and all these risk assets. Understand if you're really trying to measure your wealth, you want it in something that holds its value over the centuries. Again, a shoebox of gold coins will buy you a house anytime in the world. A shoebox of dollars will not buy you the same house 100 years, 50 years, 60 years later. It's a melting ice cube. Those dollars may be made out of paper, but they act like ice cubes. That's not fable, but fact. It's hard to understand that. It took me a long time to figure that out after chasing bond yields and sexy hedge funds and allocations and 2 and 20 fee structures and talking to PWMs, smart guys at all the banks who could talk derivatives to the point where I got confused. It was all smoke and mirrors. I just want to preserve my wealth. If you're a speculator, there's other places to go than gold. But ironically, gold has outperformed the S&P, even a total return S&P since the turn of the century. But that's not why I own gold, or why you should, in my opinion.
Considering gold's historical resilience during times of economic upheaval and the potential for significant gains if global allocations shift closer to historical norms, how do you foresee the role of gold evolving in the near future? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.